Good morning, DPS staff members. I'm Paul Wazura, Chief Financial Officer for Durham Public Schools. We're here with our third session of the summer boot camp. For those of you that attended one of the two previous ones, a lot of good information shared, a lot of good questions asked. We want to continue that for the next 3 weeks, this being week 3 of the 5 that we're giving you. For that purpose, I'm going to turn it over to Ben Pitts with My Financial Answers, and he will take over from here. This is in conjunction with Verity Investments, and they're working with us to bring you these broadcasts. So I'm going to turn it over to Ben, and he will take over from here, and he'll introduce the staff.
All right. Thank you, Paul. I appreciate it. Hi, everyone. My name is Ben Pitts. I'm the CEO of My Financial Answers. Been on with probably some of you, not all of you, over the last 2 broadcasts, and we're looking forward to this next iteration of the Financial Fitness Bootcamp. So I just wanted to quickly introduce myself. I will in a moment introduce Becky Iacopelli, who is our lead financial planner, who will go through the information, but just a couple of details. We will answer any questions that you have at the back end of the presentation, so we encourage you to stick around. Over the last couple of webinars, we've had really good questions about all of the details that that we had gone through. I think we probably had 15 or 20 questions to go through last time. So we encourage you to ask questions. It can be really interactive. We will also make sure, and I believe Paul and the staff at Durham Public Schools are going to make sure you all receive an email shortly here in the next day or two that includes the recordings of the previous webinars, as well as the recording from this webinar, and all the material that you'll need. We'll cover some of that to the end as well. So at My Financial Answers, we really have enjoyed working with Verity Asset Management and the staff at DPS to bring you this content and our tools. And at this point, I'll turn it over to Becky Iacopelli to present our information on understanding your risk score. Becky, you can take it away.
Great, thank you so much, Ben. I'm so happy to be with you guys on this financial fitness bootcamp journey. My name is Rebecca Iacopelli. I'm a certified financial planner. I've been doing this for around 7 years now, working with wealth management, financial planning, and tax as well. So happy to assist you with anything you need in terms of financial planning, and hoping you're getting some insights out of this financial fitness bootcamp. So with that, let's get started with the presentation. Okay, so welcome to week 3 of the Financial Fitness Bootcamp, which is understanding your risk score. So we hope you were able to join us for our last 2 webinars and that you gained some insights on how to manage your cash flow as well as your debt. So this week we will be learning about investing and how we can position ourselves based on our risk tolerance. And we hope you join us next week for Expand Your Plan with Alternate Scenarios, where we will look into the impact of making changes in our plan to achieve our goals. This week in understanding our risk score, we are going to dive into the basics of investing in the market and what that can mean for your portfolio and your future. Investing in the market, it requires a level of risk, and that level of risk that you can take on is different for everyone. It depends on a variety of factors, including age, time horizon, income needs, and personal comfort as well. And ultimately, understanding where we are can help us to make wise financial decisions when it comes to building our retirement nest egg. We want to make informed, sound decisions when it comes to the market, and learning a little bit more about what is involved will help us to do that. So let's start with some basics on what we can invest in. Starting with fixed income instruments, including bonds, CDs, and money markets as some examples. These are investment vehicles that provide fixed interest payments with the return of principal at maturity. What that means is that they provide a steady flow of income or fixed income over a period of time. And then at the end of that time period, the amount of money you originally invested is returned back to you. In the case of bonds, they are loans made by you to the borrower, typically a corporation or a government institution. There are a variety of types of bonds that are graded by their credit quality. Similar to how individuals' credit is rated by their FICO score, which you may be familiar with, bonds have credit ratings that are issued by bond rating agencies that let you know as the investor how much risk there is in having your principal or the initial amount of money invested returned to you at the end of the period. Investment grade bonds are bonds that are given a high enough rating to indicate that there is a high likelihood you will be collecting all of your interest payments and principal. On the other hand, high yield bonds, they have a higher interest payment associated with them because they incur more risk of not receiving your principal at maturity. Overall, bonds are generally low risk. They provide protection of your principal and also fixed income payments. Now let's look at CDs, or certificates of deposits. They are products offered by banks to deposit money and leave it untouched for a period of time in exchange for a certain amount of interest paid to you. CDs are even safer than bonds as they are protected by the FDIC, which insures them up to $250,000. There is a caveat though, as there is a penalty if you need to take back the funds before the agreed upon holding period. On average, holding periods last anywhere from 3 months to 5 years, whereas bonds can have maturities of up to 30 years. The longer the holding period, the higher the interest rate paid to you. Lastly, there are money market funds and accounts. These are liquid, short-term investments of high credit quality. These do not fluctuate in price and act as a cash alternative that offers a slightly higher interest rate than you may find in traditional savings accounts. You can access the money anytime, making this the most conservative of investments next to cash itself. Fixed income investments are conservative and safe harbor your investments against the risk that comes with the alternative, which is equities. They can act as downside protection during periods of volatility in the market and serve as a means to provide income for retirement. Next, we have equities, which includes stocks, mutual funds, ETFs, and other investments. Equity represents a shareholder's stake in the company. Essentially, by owning a stock, you own a piece of the company you're invested in, share in their good times, bad times, and also profits. You can either purchase stocks individually or in mutual funds and ETFs. Stocks pose the most reward when it comes to returns, but they also pose the most risk. And there is no reward without risk. The two go hand in hand. The goal, however, is to position yourself to have the least amount of risk for the amount of reward. This can be done through diversification. Diversification is a strategy where you mix a wide variety of investments in order to lower the risk of holding a few stocks. Diversification neutralizes the risk in a portfolio. It is said that a mixture of 25 to 30 stocks is ideal for mitigating investment risk. This can be done by holding 25 to 30 individual companies, or alternatively, by purchasing a mutual fund or ETF. Mutual funds are financial securities made of various stocks or bonds, depending on the type of mutual fund. ETFs, they do the same, but they trade throughout the day like a stock. Both mutual funds and ETFs hold hundreds of stocks in one fund. This provides a lot of diversification for your portfolio. Instead of incurring the risk of one stock going down and losing value, you hold only a small amount of that stock in the mutual fund and ETF and experience less of a loss. Mutual funds and ETFs can be actively managed or passively managed, which we'll discuss later, and this determines the fees. You can find expensive funds as well as extremely low-cost ones. The industry is very competitive at this point, and there are funds you can purchase for next to nothing. These typically track an index. Indexes you may have heard of are the S&P 500, the Dow Jones, and the NASDAQ. These represent the movement of number of companies that is indicative of the market as a whole. With indexing, you will experience the ups and downs of the market just as you see it, as they hold the same securities as the index. In terms of ups and downs, let's discuss the difference between a bull market and a bear market. A bull market is a period during which the market is rising or expected to rise. This is what has been going on up until March 2020 from 2009, the longest bull run in history. They are a result of a high demand for stocks, and this increases growth. Bull markets are typically marked by increasing economic growth, low unemployment, and a rise in corporate profits. The average period of a bull market is 9.1 years and experiences an average growth of 480%, a significant reason why it's so important to be in the market in order to grow your nest egg. Unfortunately, though, there is no crystal ball, which is why consistently being in the market is most important. Missing out on this kind of growth for the fear of a downturn is extremely detrimental to a portfolio. Bear markets, on the other hand, are periods where the market falls 20% or more. A large amount of stock selling occurs during this period, and people are also looking to buy fixed income securities, especially those issued by the government for the safety net they provide. However, this is actually the worst time to be selling. When selling during a bear market, people often buy high and sell low, which is the opposite of what you would want for your portfolio. And they often miss out on the bull market that follows because they cannot predict when they will start. And getting in late in the game causes them to buy high after they've already sold low. The average period of a bear market is 1.4 years and experiences average declines of 41%. Although rough, they pale in comparison to the growth of the bull markets, and thus should be seen as temporary and not a reason to jump out of the market. In fact, they are a great time to purchase more stock as they can be purchased at a great discount. Bear markets, though, they can be a true test of your risk tolerance. Our risk tolerance is the level of risk in the market you are willing to take. It is the gauge of what allows you to sleep at night comfortably, knowing your assets are aligned with your goals. Those with a high risk tolerance can go through the downturns like what happened in March 2020 and not worry over the losses that are in their portfolio. They are confident that the market will come back and that their portfolio will recover, just as it has so far today off the March lows. Risk-averse individuals, on the other hand, are checking every day, sweating over their losses, and feeling like they need to sell and get out of the market entirely. They cannot weather the storm. Maybe they should be in equities based on their age and time horizon, but it has to be limited to exposure due to their anxiety over the market downturns. Certain factors affect the level of risk a person should be willing to take, and these include your age, time horizon, and income needs. When it comes to retirement, your age and time horizon are a large factor. When you are 25, you have about 40 years until retirement. That is plenty of time to ride out downturns and experience the significant growth that comes with having a high percentage of equities in your portfolio. As we discussed before, bear markets only last around 1.4 years, and bull markets last over 9 years on average. Thus, you will spend most of your time in the market experiencing bull runs and steady growth. As you get older, however, and your time horizon decreases as you come closer to retirement, your risk tolerance will go down. You won't want to take as much risk as you creep closer to retirement, just in case you run into a downturn right as you begin your retirement. Income needs also play a role in your risk tolerance. You will need to take on less risk in order to secure your income. You need money to live, and you want to ensure that money is available to you without much fluctuation. Fixed income investments are typically the vehicle used to provide income, and less equities are used in an income-based portfolio. Personal comfort is also a factor, as mentioned before, as you have to be able to ride out the storm without feeling the need to sell, which can really hurt your overall return. This will vary from person to person and will determine how much risk you are willing to take. Now let's discuss why one chooses to take this risk. Risk is required in order to experience the rewards. The higher returns come with higher risk, while the low returns come with lower risk. As mentioned before, equities pose a higher risk than bonds and other fixed income investments, but are often necessary to building a nest egg for retirement. According to Morningstar, which is a research company, since 1926, the stock market's average return is around 10%, while the bond market's average return is around 5%. Let's take an example of someone investing $5,000 a year for 40 years at each of these rates. If the person invested in bonds, they would have $604,000. While if they invested that in stocks, they would have over $2.2 million. We certainly don't want to miss out on the difference in results. To put that in perspective, the amount of income provided by $604,000 is around $30,000 per year in retirement at around a 5% return, while the income you will receive from a $2.2 million investment is over $110,000. That is a large difference in the quality of your retirement. It's important to weigh these factors when deciding what is right for you in terms of allocation between stocks and bonds and what level of risk you're willing to take. I recommend listening to your advisor in terms of what level of risk you should take and what will be right for you depending on how much you are contributing versus how much you will need to provide for your lifestyle in retirement. There is no need to take on additional risk that you don't have to, so calculating the ideal scenario based on your financial plan is the best way to go. Get in touch with My Financial Answers through Schedule an Appointment to determine your income needs in retirement and the target savings rates that are required to get you there. One of the major factors in determining your risk score is your investing time horizon. When will you need the money? Long-term investments are typically held for more than 1 year and typically more than 5 years. With long-term investing, you can take on great equity risk in your portfolio because holding for the long term mitigates the risk of downturns. Along with a long time horizon comes with greater return potential. This is typically the strategy behind retirement accounts. Retirement is usually the longest investment horizon for individuals and allows them to take on equities that otherwise they would not with a short-term horizon. Short-term time horizons are less than 1 year. In this case, you should not be taking on equity risk. You can alternatively invest in fixed income vehicles such as a CD that matures within your time frame or a money market fund that is completely liquid so it can be taken out at any time. These are typically time horizons for an emergency fund or for a specific purpose, such as vacation or the down payment on a house. Emergency funds should always be held in cash or money market funds, whereas if it is for a specific purpose, bonds or CDs can be used with short-term maturities. Of course, be aware that the money may fluctuate in the case of bonds or be locked up in the case for CDs. Be sure not to take on equity risk for short-term time horizons, even if you feel as though the market will be going up during your time frame, because you never know what is going to happen. You have to weigh the risk versus the reward. And the risk of not having your down payment on your house because of a market downturn is really worse than missing out on some growth potential by having it in the market. So save the equities for your long-term goals. In accordance with your risk tolerance or your age, time horizon, and income needs, you'll want to select your proper asset allocation. Your asset allocation is the mixture of equities and fixed income in your portfolio. This, of course, as we discussed before, depends on your risk tolerance and investment objectives. But there is a standard allocation that comes with different age groups. This represents the standard capacity for risk at these various ages. This may not be your tolerance, but it may be your capacity based on your retirement time horizon. As you can see in the chart, from your 20s and 30s, you should have around 90 to 100% of your portfolio in stocks. In your 40s, from 80 to 100%. In your 50s, from 65 to 85%. Your 60s, from 45 to 65%. And in your 70s plus, from 30 to 50%. As you can see, the equity exposure steadily decreases over time. As you inch closer to retirement, you want to reduce your exposure and add more protection to your portfolio via bonds and cash. This is because you will be going through fewer and fewer market cycles as you get older, and you want to be sure you have the protection in your portfolio to ride out a downturn that may coincide with your retirement. When you retire, you also want enough bonds to provide income to maintain your lifestyle with a level of security greater than that which equities provide. So talk with your advisor to discuss which asset allocation is ideal for you, as there are ranges and also factors to include, such as your personal risk tolerance. They can help you identify what's right for you based on your overall financial plan. Once you've determined your risk tolerance and selected your asset allocation based on your financial plan, you have to choose what you will be invested in. There are two different types of investing that are options for you in your accounts, including those offered to you through your employer. You can choose between passive or active, or even a combination of both. A passive portfolio is one that is intended to track an index and will always perform in line with that index. For example, an S&P 500 index fund would incorporate all of the 500 companies within that index and track it almost perfectly. Whatever the S&P 500 does, as you can watch on CNBC and other channels, that is what your performance will be as well. There will be no outperformance or underperformance. What you see is what you get. On the other hand, with active management, there is individual stock selection. This can be within a mutual fund or an ETF that may be available to you through your employer's plan. Active management is intended to outperform an index. The manager of the fund or the portfolio chooses stocks based on their strategy with the goal to have a greater return. The alternative scenario, however, is that they underperform the index, which due to human error and the difficulty of outperforming an index is very common. It's up to you whether or not you want to take the risk of possible underperformance for the reward of possible outperformance. Yet another example of risk versus reward. Passive strategies are also typically buy and hold strategies. This means that what you purchase, you intend to keep and not sell for a long period of time. This is contrary to active management, which typically involves more frequent buying and selling. Active managers buy and sell companies based on information they research and determine that the value of the company requires a buy or a sell at an optimal time. There is a cost to this and also a lack of tax efficiency. Active managers are more active, hence the name, in managing their funds and therefore require a higher cost. Active funds may cost you around 1%, whereas passive index funds will cost you on average around 0.2%. Some can even get as low as 0.03. Due to this higher frequency of trading in active funds, they are also less tax efficient. This is because trading incurs capital gains, which then require you to pay capital gain taxes. Passive funds do not have this frequency of trading and therefore have less capital gains incurred. One possible benefit of active management is downside protection, which is not available in passive funds. Active managers do their best to beat the market, and that is especially important during market downturns where they attempt to lessen the negative returns in their own funds. You will pay a fee for this protection, and you may not even get it as there is a possibility they could do even worse in the market. Again, just another example of risk versus reward. With passive funds, you will experience what the market experiences, downturns included. The way to protect against downturns with passive investing is having the correct allocation of bonds that will ease the blow of a fluctuation in stocks. Now let's discuss where you can invest in these funds. You certainly have the ability to do so in your own brokerage accounts, which are just individual accounts where you can hold stocks and bonds. But most tax efficient and beneficial to you is to invest in your retirement via your employer-sponsored plans or via IRAs, which we'll discuss next. 401ks, 403bs, and 457s may be offered to you through your employer. These accounts let you contribute either pre-tax or post-tax, depending on your choice. When you contribute pre-tax, you can reduce your taxable income by the amount you contribute. The money grows tax-free over the course of your holding it in the account. Then when you take the money out in your retirement years, it is taxed at ordinary income rates. This is most beneficial when you are in a higher income tax bracket now than you will be in retirement. For example, if you are in the 24% tax bracket now because of your income, but will be in the 12% tax bracket in retirement, then it is better to take the tax savings now. In that case, you would contribute to your plan on a pre-tax basis, or the traditional route. Alternatively, though, you can contribute post-tax, or in a Roth 401k, for example. In this case, it is the opposite. You do not receive a tax break now, but when you take the money out in retirement, it is tax-free. In this case, you want to choose the type of account when your tax rate will be higher in retirement. Perhaps you are in the beginning of your earning years and have not hit your highest potential yet. Contribute to a Roth account and then switch to a traditional 401k or 403b when your income increases. Contributions to these accounts can be up to $19,500 if you are under the age of 50, and if you are over the age of 50, you can contribute an extra $6,500 for a possible total of $26,000. The other benefit is that if you have enough funds, you can contribute to two accounts at once with the availability of the 457 account. The 457 is available to government and nonprofit organizations and offer additional chances to increase your retirement nest egg. You can contribute to both a 403b and 457, for example, and you can contribute up to $52,000 between the two. In terms of choosing between the 401k and a 403b, they are very similar in tax treatment. However, there are often more investment choices in the 401k than there are in the 403b. You will have to contact your specific provider to determine which account you would like to choose, but both are great options for saving for retirement. It is important to remember that distributions from 401ks and 403bs before age 59 and a half will incur a 10% penalty, whereas the 457 does not have a 10% penalty with early withdrawals. Of course, the intention is to save for your retirement, and hopefully you are not taking early withdrawals from your retirement accounts. For help enrolling in these plans, please visit My Financial Answers and click on the My Benefits tab. From there, you can access Prudential's website, your retirement plan provider at DPS, and get started with your savings. In addition to contribution to your employer-sponsored accounts, you can also contribute on your own to a Roth IRA or a traditional IRA. These are very simple to open at a bank such as Charles Schwab, Wells Fargo, or even your local credit union. The difference between the two is the same as mentioned before with the post-tax versus pre-tax. It depends on your income now versus your income in retirement and when you expect it to be more. Once again, choose a Roth if your income will be higher in retirement and a traditional if your income is highest now. The Roth is an after-tax contribution, so you will see tax-free growth and tax-free distributions at retirement. Alternatively, the traditional IRA provides a tax deduction up front on your taxes for the year and has taxable withdrawals when you are retired. You will also receive a penalty if you remove the funds before 59 and a half. However, in the Roth, since your contributions are made after you have already paid tax on the funds, you can distribute your contributions tax-free without penalty. Not the growth, only the contributions themselves. The contribution limits for both of these accounts are $6,000 and an extra $1,000 if you are over the age of 50. You can contribute to both if you wish to do so, but the amount cannot be over the limit provided by the IRS, which is the $6,000 and $1,000 extra if you're over 50. There are income limits for both, so be sure to look into whether or not you qualify to contribute to these accounts before you do so. Our goal is to have you as well prepared as possible for retirement. There are many ways to get there, but identifying your risk tolerance and the asset allocation that goes with it is extremely important in maintaining a solid investment strategy to achieve your goals. In order to identify your personal risk score, use the link sent in the follow-up email to go through your personal risk questionnaire. You can then use this information to help you make the proper choices when building out your retirement portfolio. There are many choices along the way, and your advisor can certainly help you in making those choices. But we hope you gain some knowledge for yourself through this brief introduction that will help you make some well-advised decisions for your retirement portfolio. Before going to your advisor to help with your investment decisions, build your financial plan through My Financial Answers to determine how much you need to save for retirement and what investment vehicle you should use to do so. Use the Calendly link provided in the follow-up to set up an appointment and speak with an advisor. So we thank you so much for joining us, and we hope you join us next week for Expand Your Plan with Alternate Scenarios. So we look forward to taking your questions.
All right. Thank you so much, Becky. That was fantastic once again. So I just want to invite you all to ask questions at this point. Please, any questions you have at all. There's no question that's out of bounds. We'll do our best to answer whatever questions that you have. So please ask some questions now. I'm actually going to ask a couple of poll questions of you all. We would love your participation. I'm going to go through 3 poll questions, and while we're going through those poll questions, I'd invite you to ask some questions. We already have a handful that we're going to ask right away. So let me go ahead and launch. And there's some questions coming in. Great. So let me go ahead and launch our first poll question. Our first poll question is, what is your investment experience? So I'm going to launch this poll, and you've got a couple of different options here. I've got none, I've got limited investment experience, I'm knowledgeable, or I've got extensive investment experience. So we'll go ahead and wait for everyone to answer that question. We've got some questions rolling in, which is fantastic. We'll get to those in just a minute. Just a reminder, while we're answering this poll question, we will make sure you get this recording and all of the other ones. That's been a question that continues to come up in the next day or two here, so you'll have access to all 3 of the webinars we've done. And don't forget to join us for with two more series remaining, 2 more webinars remaining in the series. So All right, I'm going to give you about 10 more seconds to answer the poll question. We've got some questions coming in, which is great. So I'm going to close out this poll. Looks like we're about done. Close poll, and I'll share the results with you all. So we've got zero. Nobody has extensive investment experience, which is not uncommon for a group. But we've got a fair share that say no investment experience, about 25%. 66% of people say limited investment experience, and then 9% of people say that they are knowledgeable. So all the more reason for us to think about getting some professional advice when it comes to investing. Many of us are actually in that boat. I'm going to go ahead and ask our second poll question. Let me go ahead and close this one, if I can figure out how to do that. Hide results. All right, we're going to ask our second poll question. Please continue to ask any questions you have. We'll get to those in just a second. So I just launched our second poll question. If your investments dropped 20%, what would you do? So if your investments dropped 20%, let's just say you had $100,000 invested, it fell $20,000. What would you do? Would you have no stress and maintain your strategy? Would you worry but maintain your strategy? Would you sell the bad performing mutual funds or ETFs or stocks? Or would you just get out of the market and move all of your investments to cash? Let's see where we are. We'll give it a little bit of time. Looks like we got some great questions coming in. Fantastic. We have one more question after this, and we'll get right into those questions. Just hope you all stick around. All right, we'll give it about 10 more seconds for people to reply to the polls here. And all right, let's go ahead and close this poll, and I'll share the results. So we have, if your investments drop 20%, what would you do? 21% of people say no stress, maintain their strategy. So they're probably feeling pretty good in the last couple of months here with all the volatility in the markets. 71% said they would worry but maintain their strategy, which is good. It is stressful when markets go up and down. And we have 8% of people that say they would sell their bad performers. Becky, we can probably address that in the questions and answers here. And then 0% said they would get out of the market completely. So great answers there. We'll make sure that we have some commentary on these questions as we go through the Q&A. Let me ask our last poll question. Let's go ahead and launch. Do you contribute to a retirement account, i.e. 403B or IRA, Roth IRA, any retirement account? So select one of the following. I cannot afford to, don't have the cash flow, don't know much about it, I'm not sure how to do that, I'm relying on Social Security and my pension, or yes, I'm contributing. So would love you all to answer this final poll question, and we'll get right into the Q&A. And we've got answers rolling into the poll while we've got questions rolling in for us to address after this. So we'll just give it a few more minutes, or a few more seconds, I should say. So still got some answers coming in. Our next webinar will be the same time next Tuesday, by the way. All right, let's give it about 3 more seconds, and we'll close out this poll. So our answers are: do you contribute to a retirement account, i.e. 403B IRA? About 10% of people say they cannot afford to, just don't have the excess cash flow to do so. 19% say don't know much about it. 4% say they're relying on just Social Security and pension. And 67% of people say yes, they are contributing. So we all certainly have different circumstances. And so again, I think we'll try to come back to these poll questions, Becky. And I'm sure some of these questions will lead us there. With that, I'm going to jump right into the questions. We're going to try to get to every single one of your questions, so please stick around for the presentation. I'll ask the first question we have from a member of our audience. If you previously had an IRA with a bank and the bank no longer exists, how do you find the money? Becky, any insights on that?
Yeah, so that's a good question. I've never heard of that actually happening, but that's an unfortunate situation for sure. What's good to know is that IRAs are FDIC insured, so you definitely can get that money back if something has happened to it. I would contact the old bank to see if they have any customer service that would allow you to find out where that money actually went. But it would certainly be rolled over into another bank, perhaps the bank they turned into. but the funds certainly should still be there. I would just definitely contact the provider to find more about that situation.
Yeah, I would agree. All right. Where can we find the recorded webinars? We've already answered that. Again, we will send I think the public relations office at Durham Public Schools will get an email out in the next day or two here. Yeah, somebody else said they participated in the previous sessions, have not received the follow-up. Yeah, we apologize. There was an issue with GoToMeeting where follow-ups were not going out that we were just made aware of. So again, we're going to make sure that we send out those recordings through Durham Public Schools directly. So we've got a couple of people that mentioned that. So I have an IRA account. Should I consider converting it since I am already 59 and looking at retiring in 9 years? I have an IRA account. Should I consider converting it since I'm already 59 and looking to retire in 9 years? Any thoughts on converting it? You know what that might mean, Becky?
Yes, well, you can convert it to a Roth IRA. I'm not sure if that's what you're referring to. But it's important if you're converting it into a Roth IRA to do that actually when you retire and when you have a low income tax bracket, because that's going to cost some taxes for you. It's going to be ordinary income. So you want to make sure you have a low tax bracket if you're going to convert that money. It is a good idea to do so because then the Roth account is tax-free and has tax-free distributions. So I would certainly recommend doing that. Contact your tax advisor as well so that you could get a layout of what your tax situation looks like and what that would mean. If otherwise, I'm not sure if you just mean taking the money out. You don't need to convert an IRA to take money out for retirement. You just take it directly from that account. So if that's what you're referring to, you can just take directly from the IRA for your retirement.
Awesome. Yeah, we definitely recommend talking to your tax advisor to get specific advice on situations that involve tax. So another really good question here. If you've not saved up for retirement and you have a teenager who will graduate in 4 years from high school, I presume, are there ways to save for retirement and also help save for college? Any thoughts on that?
Yeah, so it's a very tricky balance in terms of saving for retirement, saving for college. But what's important to remember, what I like to say is that you can borrow for college, but you cannot borrow for your retirement. So it's important to remember that because there are loans available for college education that you can help your child with personally, such as Parent Plus loans, but you can't borrow when it comes to retirement for your living expenses. So it's really important to make sure that you are comfortable and you have enough money in your nest egg to make sure you can retire before putting that on hold to contribute to your child's retirement accounts. If you have money for both, I would recommend contributing to a 529 plan for your student, because that will allow tax-free growth and also tax-free distributions from that account.
I love that, Becky. You can borrow for college, but not for retirement. Well put. Okay, good deal. The Roth 457 yearly contribution limits are the same as the Roth IRA contribution limits, but you can contribute to the maximum to both for the same individual. Correct? 6,000 plus 6,000 or 7,000 plus 7,000 at 50 or over.
Yes, so you can contribute to the Roth 457. That's the 19,500 plus an extra 6,000, and then you can also contribute to a Roth IRA, which you would do on your own with the $6,000 and $1,000 contribution limits. But just make sure that you look to your income and your tax advisor, because there are income limits to contribute to a Roth IRA. You can contribute to a Roth 457 without any income limits, so you don't have to worry about that. But when it comes to your Roth IRA on an individual basis, there are income limits for doing so.
Yeah, and just to be clear, the contribution maximums for those two different types of accounts are different, as you just said, Becky, for the 457 Roth versus the traditional, or the Roth IRA, I should say. So I just want to make sure that's clear, just based on the question I'm looking at here. It was clear in your answer. Just wanted to reiterate that. All right. So another question here: is it better to invest in retirement benefits like a 401k than life insurance? Any thoughts on investments versus life insurance? And I'm assuming. Yeah. Well, go ahead, Becky. Good.
Yeah. So I would definitely recommend investing in your 401k over investing in life insurance. Oftentimes you might be talking about whole life insurance, which offers an investment vehicle with it. But there's a lot of high costs to whole life insurance. There's also a lot of fees that come with surrendering it and being able to withdraw those funds. And also they typically have lower returns than the market will have for you. So you're definitely better off investing in the 401k. There's a lot more flexibility. That money is available to you at all times. And also there's high returns that are associated with it.
Yeah, I would make sure that you absolutely, when you're asking questions like these, consult your investment advisor. If you don't have one, seek one out. A lot of these things are very personal, and it sort of depends on what's available to you. Which one's the best option? You just want to make sure that you're choosing the best option that you have available to you. So we'd encourage you to speak with an advisor about that in your situation. Is it possible to do a backdoor Roth IRA if you have an employer-sponsored plan and already contribute the max to the Roth IRA? Household income qualifies for full Roth contributions. Did you catch that, Becky? Should I repeat it? Is it possible? You got it? Okay.
Yeah, so if your income limits allow you to contribute to a Roth already, then there's no need to do the backdoor Roth. I would just recommend contributing to the Roth itself. When it comes to doing a backdoor Roth for your 401k's contribution, they're actually available to you through IRA contributions, not through the 401k. You would actually have to take a taxable distribution to do that. So I would just recommend contributing to the Roth itself if you have that income availability.
Got it. Yeah. So again, anytime you're making decisions that involve tax, we'd recommend you speak with somebody that is a tax advisor. And then all these things are so personal. So again, we encourage you to set up a meeting to talk about your personal situation and what the best approach is. A lot of these, Roth conversions and backdoor, all these things have a lot of detail involved in them. So hard to address every single detail about those in a general webinar. So be sure to reach out. Still have not received the link. Okay. Hopefully we get that to you. I had a 403B with a previous employer. That company doesn't work with the current employer, and a representative told me that I can keep the account for 8 years. Should the money be withdrawn now or attempt to keep it for the full 8 years? I'm not sure where that 8 years would apply to. I had a 403B with a previous employer. So I guess this is really, I'm not working for that employer anymore, Becky. What should I do with that, money? Should I roll it over? How should I treat that?
Yeah, so I would recommend rolling that over into an IRA. So you would have to open an IRA with a bank. You can do that with, like I mentioned, a custodian like Charles Schwab or your local bank as well. So what you would do is roll over the funds, and there's no taxable event when you roll over the funds. So you can just simply roll over that 403B into an IRA. That also opens for you more investment options than it does in the 403B. And it also doesn't include administrative costs, and there are administrative costs when it comes to your 403B. So I would certainly recommend getting that money out of there and rolling it over into a traditional IRA.
Yeah. So if you want more details on how to go about that, again, seek out an advisor. So, okay, to clarify the backdoor Roth question, if still working for the employer-sponsored plan and no plan to sever service, and I already contribute the max to the Roth IRA and 403B 457, but want to open up an IRA for the express purpose of converting to a Roth and paying the estimated taxes on this money, I think there's a little clarifying question. I don't know if you want to address that, Becky. We certainly could take that question offline.
Sure.
So deep.
Well, you can only contribute $6,000 or $1,000 to a Roth or a traditional IRA. So you're only going to be able to do one of those options.
Yeah, just be sure to reach out. We can address that question, personally with you. So might be some detail that we're missing in your question. I can retire from the state in October of 2021. I will be 52 years old. I haven't contributed to my IRA in years. Should I convert back to a 401k? I also could continue to work for another 10 years. If that should I keep the IRA? I'll be 51 on Sunday. So I will start by saying it sounds like you have a lot to think about. When to retire, how should you invest, where should you invest your money as you plan to retire? And I think when you have questions like that, that's the perfect time to actually think more broadly about your financial situation and what your retirement looks like, and do some financial planning. That's my first instinct, Becky, when I hear a question like this, but I'll let you address it as well. Go ahead.
Yeah. So you can't move an IRA back to a 401k. And those IRA funds are available to you at 59.5. So you're going to have to wait a little bit when it comes to that. Hopefully your pension, if you're a teacher or you work for the school district, will help you out in that regard. But I would certainly recommend contributing to your 401k if you have the ability to do so. But just keep in mind that those funds will be only available to you at 59.5.
Yep. Awesome. Thank you, Becky. Good deal. Please explain how Roth IRA contributions are not taxed, but growth is taxed. How does that work when I want to take out funds? So could you just clarify how a Roth works, actually, Becky? That'd be helpful.
Yeah. So when you contribute to a Roth, you already paid taxes on the money because you're not getting a tax deduction. So that income that was made to you, you're paying taxes on your tax return like normal. It's just cash in your account that you have excess to contribute to your Roth. So that money has already been taxed by the government. So what that means is that you contribute to the Roth, you don't get a deduction, but that money grows tax-free in that account for the life of the account. And then at the time of distribution, when you retire, since you've already been taxed long ago, that money is now tax-free. So it has no tax impact when you take that money out.
Yeah. Good deal. All right, just a couple more questions. Can I start an IRA account for my kids? Maybe you can address some savings options for kids here, Becky.
Yeah, you can absolutely start an IRA for kids. You can even start a Roth IRA, which would allow you to take some money out for education purposes as well. But I recommend contributing to a 529 plan for that if you're going to do that. You can also open custodial accounts for your children as well. So you can certainly open IRA for a child and help them start saving for retirement early.
Awesome. All right. I have two more questions, Becky, and then we can close it up. I actually think these two questions are really good ones. How should my pension and Social Security impact my decisions on how to invest?
Yeah, so I would recommend talking to me through schedule an appointment for this question because if you have Social Security and you have your pension, that means you don't quite need to invest as much as you would otherwise if you didn't have those options. So that really affects how you should invest because you have those fixed payments that are coming to you. It also means that you can invest a little more in equities because you have the protection of already having fixed income payments that are going to be paid to you for life. So it really changes the amount that you contribute as well as what you contribute to and in. So I would definitely recommend talking to me or an advisor so that we can figure out how much you would need to contribute to retirement and what that should be invested in as well.
Awesome. Thank you, Becky. Oh, we got a couple more questions here, actually. If we use the coupon code, do we get a free session with a financial advisor? Are they a fiduciary?
Yes. So you would, for example, right now, you would talk to me if you had scheduled an appointment. And I am a fiduciary. I'm a certified financial planner and obligated to be a fiduciary as a result of that. So I could certainly help you out, and I would do so, of course, as a fiduciary in your best interest.
Yes, and you all can have more than one conversation with Becky. Hopefully, we can get all your questions answered and your financial plan complete with a single session. But if it requires more than one session, you can do that. There won't be any payments due through My Financial Answers is a free benefit through Durham Public Schools. Another clarifying question about the Roth IRA, Becky. Will the increase, I guess, the investment returns in the Roth account be taxable?
Yes. So the growth in your investments is tax-free. So that growth is not taxable. It's just a benefit that's available to you through the graces of the IRS. So that's why contributing to a retirement account as opposed to just an individual brokerage account for your retirement is recommended to do so in those vehicles that the IRS allows for you that just add an extra benefit. So it's just the kindness of the IRS that lets you contribute to a Roth and have that money grow tax-free for the life of the Roth.
Yeah, maybe there's just some confusion with the traditional IRA where you would be contributing in a traditional IRA with pre-tax dollars, and eventually you do pay taxes on a traditional IRA when that money comes out when you take distributions at whatever tax bracket you're you're at when you do retire. So the Roth IRA, very different in terms of how and when it's taxed than a traditional IRA. So I'm not sure if that's why that question keeps coming up, Becky, but good answer there. Is there a link we can use to schedule an appointment with Becky? Yes, there is. You will receive that in the follow-up email that I promise you all will get in hopefully the next 24 hours here, with the recordings as well as a link to schedule some time with Becky. Somebody else says, where is Becky's contact information posted? Again, it will be in that email. And then another question about a link to schedule the appointment. So it looks like we've actually addressed all of the questions at this point, Becky, I believe. Actually, one other question here. Could you explain the benefits of the 529 versus the Coverdell versus other options for saving for college?
Yeah. So with the Coverdell versus the 529, the main difference is that you have a limited contribution through the Coverdell. There's income limits as well as a $2,000 contribution limit, I believe. But the 529 plan is open to any amount of contribution, and there also is no income limits when it comes to that.
Yeah, good deal. Well, that actually concludes our questions and answers today. Everyone, we really appreciate you joining. Again, we encourage you to join us next week for the fourth of 5 installments for this boot camp. Becky, thank you so much for taking the time. Everyone, we will again send out the recording for this webinar as well as the ones we've done in the past, so you can go ahead and review those. Our team at My Financial Answers thanks you. We look forward to speaking with you all again. And Becky, any parting words?
Thank you so much for joining. I hope these sessions are really bringing some light to your financial situation. Hopefully we can discuss together through through schedule an appointment, and we can get some more clarification on your goals. So that's what we really hope to accomplish.
Awesome. All right, everyone. Thank you very much. Have a wonderful summer. Stay healthy. We'll talk to you soon.
Bye-bye.